Hey everybody, Stephen Sitkowski here. I am the Chief Investment Officer for Market Mastery Group. I'm also one of the co-founders and partners and super excited to share with you my technical analysis series. I think the best way for us to attack the whole principle of how we read a chart, let's break it down into its individual components, shall we? So what we're going to do is I will sort of lay out for you the basics on a slide, and then we're going to go live and check out a chart. Sound like a good plan? Sounds like a good plan to me. Okay, hopefully you've got note paper, pen, got real stuff for you here today. All right, so we're going to begin this journey with one of the most basic of all the technical indicators. It is called the moving average. So first of all, what is a moving average? It plots a series of closing prices and averages them over some period of time. So let's say we wanted to look at a 3-day moving average, just hypothetically. So let's say the stock closed at 10, then it closed at 11, then it closed at 12. How would we get the moving average? We take those three numbers, add them together, divide by 3. So if it was 10, 11, and 12, what would the moving average be currently? It'd be 11, right? Okay, so that's what a moving average is. Now, there are two different types of moving averages. There's what's known as a simple moving average, and I gave you an illustration of that. There's also something known as an exponential moving average. So an exponential moving average, there is an algorithm where more weight is given to what has happened most recently. So the difference in a simple and an exponential 10-day moving average is negligible. But if you are looking at a 200-day moving average, it can be pretty significant. So, the question is always, which moving average do you use? Generally, I'm looking at shorter term moving averages, and I look at simple moving averages, and I'll show you which ones I use. Next, when a stock is trading above its moving average, it is considered to be bullish, meaning more likely to go higher. When it is trading below its moving average, it is considered to be bearish. So if I were looking to buy a call option, I'm typically going to buy a call option on a stock that is trading above its moving average. If I were looking to buy a put option, then in that case, I would be buying a put on something that is trading below its moving average. Then we have found that over the years, moving averages, regardless of which moving averages we're looking at, meaning relative to length of time, very often act as points of support and resistance. So let's take a 50-day moving average. So you may see a stock that's trading above the 50-day, it starts to come down, it hits the 50-day, and then it'll bounce. And then it'll come down, it hits the 50-day again, and then it will bounce. Or conversely, stock is moving up, bumps up against its 50-day moving average or 20-day or whatever moving average we're using, and then we see it come down. Now, some stocks pay more attention to their moving averages than others. So it doesn't always work perfectly. And that's the thing about technical analysis. You're going to look at various different technical indicators and put them together, and hopefully they will spell out some kind of a picture for you. So again, above our moving average, we are bullish. Below the moving average, we are bearish. All right, so let's talk about various moving averages. So the 200-day moving average is very good when you're trying to figure out a long-term trend. So you may want to know what the long-term trend is on the stock market. So you may look at the DIA, which is a proxy for the Dow Jones Industrial Averages, or the SPY, which is a proxy for the S&P 500. But the 200-day, the other thing that is significant about the 200-day is it seems like that's one of the moving averages that institutions tend to key on. Now remember, institutions like hedge funds, mutual funds, big investment banks, they're not going to dart in and out of positions like you and I because they move the market. So they're going to take a longer term view. So if they see a stock that crosses above or below a 200-day moving average, it's kind of a big deal to them. The 50-day moving average is what we call the intermediate term trend. So whereas the long term, that might be for a position you are planning on holding for months or years, the 50-day could be weeks or months. So a crossover, a longer term moving average, is always deemed more significant on a macro level than a shorter term. One of my favorite moving averages, and the one that I normally have on my screen if I'm just looking at stocks, is the 30-day. So there's lots of good reasons for the 30-day. I find that it tends to hold stocks for support and resistance pretty well. And also I've learned there's kind of a symmetry about the 30-day. If a stock goes above 30-day moving average, if it crosses below, it tends to go below about the same height as it went above. So it allows me to predict not only that the stock's going to go lower, but how far lower. And the reverse of that is also true. And then we can stack moving averages. What exactly does that mean? So we can look at one moving average versus another. So let's say that we had a chart that had the 200, the 50, and the 30 as an example. In a bullish move, the 30 should be above the 50 should be above the 200. If it's not like that, then you have what we call mixed signals. We don't trade on mixed signals. And we look for these moving average crossovers. So the 50 and 200, when the 50 crosses above the 200, the term in our industry is that's a golden cross. When the 50 crosses below the 200, that is a death cross. When I'm doing short-term trading, I like using the 10-day and the 30-day. When the 10 crosses above the 30, that is a bullish signal. When the 10 crosses below the 30, that is a bearish signal. So why don't we look at what this looks like to move a 200-day. So there we go. That blue line takes a lot. Remember, that's an average over almost a year. So you're not going to see that going way up and way down. But you'll notice that we're trading well above the moving average. The market was bullish, and then it crossed below when the SPY was at 296. And then it dropped way down here to 228, right? So that was a big trend reversal. And it's just now coming back up above the 200-day moving average. So it shows you where things are bullish and where things are bearish. If we looked at a stock like Apple had been doing so good for so long, it barely crossed below down here. And then it popped right back up above. Look at that, Apple's trading almost about where it used to. Been a very, very strong performer. How about Microsoft? Same story, okay? So that would be the 200-day moving average. Now, what if I wanted to add to this a 50-day moving average? And let's change the color. Let's see how red shows up. Okay, so let's go back to the SPY. And there's one of those crosses right there. See how it dropped below? Okay, so 200 days in blue, 50 days in red. And notice it crossed above the 50-day before the 200-day, crossed below the 50-day before the 200-day. So most traders would be more inclined to use a 50 than a 200. 200 would be for an institution. Does that make sense to everybody? Now, let me show you a couple of my favorites. So I told you that I really like, and generally on my screens, you will see a 30-day moving average. We'll use yellow for it. All right. Now, remember when I said that it acts as a level of support and resistance? Look, right here, bounced off, bounced off. When it crossed below, dropped way down, crossed above. Look how it bounced off again right here. Okay. So that's why I typically prefer the 30. And let me add one other moving average to this. Yellow's fine. I'm going to use the 10-day. So again, generally speaking, I will have the 10-day and the 30-day up. When the 10-day is above the 30, we are bullish. When it crosses below, we are bearish. And look at how well that worked. So just a little bit right there on moving averages. Did you find that interesting and did you find it helpful? I certainly hope so. If you have any questions, feel free to write me. Now, I do free webinars a couple of times a week. We change the days. We've been doing Monday, Thursday, but that's always subject for change. If you would like to be able to attend one of these webinars, typically they last about an hour. Technical analysis is just one of the things that we talk about. They are absolutely free. So if you want to connect with us, click register and we'll get you in. Hope to be seeing you soon. Till next time, God bless.